Welcome to Fraud Friday. I'm Bob Coleman. Fascinating story out of Oklahoma, Carnegie, Oklahoma, first Farmers Bank. Bank started in 1907 and ended up being run by a sixth generation descendant of the original ownership group, Aaron Johnson. Mr. Johnson got himself into a little bit of trouble, but before I get to that, let me tell you a little bit about the bank. Carnegie, Oklahoma, population of less than 2,000. It is sad what's happened in rural America with the closures of all these small independent banks, and you can see the challenges these banks have exhibited in this story. Aaron Johnson was president of a bank that had sales revenues of only $3.5 million. That's the size of a McDonald's. A good mom and pop, an average restaurant does $2 million. Good mom and pop diner can do better. So you're talking about a small business. That bank had deposits of $90 million, a capital of $10 million. Now, the regulators don't care about the capital. That is the risk capital put up by shareholders for a return, perfectly legitimate. But it's the depositor funds that the feds get all excited about, because if the bank has too much losses, all those deposits are guaranteed by the U.S. taxpayer through the FDIC, and you have too many losses, therefore it's going to start costing you and I money in the forms of subsidizing that FDI insurance. So that is the issue, and that's why regulators get very concerned about the health of small banks. Aaron assumed his duties at the age of 34. Why is that? Well, Dad got in trouble with the feds. He had a cease and desist order. Let me give you the date here. This is back in 2019. Now, he didn't admit wrongdoing, but the respondent, no, he did not admit nor deny wrongdoing. The respondent engaged in unsafe or unsound practices and breached his fiduciary duty of care by failing to prudently or diligently carry out his oversight responsibilities as director of the Farmers Bank of Carnegie, Oklahoma. This included ignoring a bank officer's misuse of bank funds and also facilitating and accepting loans from the bank that were on better than market terms and without the appropriate approvals, i.e. loan committee and the board of directors. So he simply went in and sounds like he was approving loans. He got himself in trouble. So who takes over? Sixth generation, the son, Aaron Johnson. Now, again, $3.5 million in revenues, but he quickly put on a show. Let me read you. This is from the sentencing guidelines or the sentencing recommendation by the prosecutor. From the start, Mr. Johnson's expensive taste put the bank in a precarious position. Described by his former CFO as a flashy young executive who liked to spend excessively on clothes and travel. He flaunted his lavish lifestyle, featuring himself driving an expensive Audi, clad in a gold Rolex watch, and a self-produced promotional video for the bank. He had absurd amenities in his office, including a custom ping pong table, an electric scooter, a coffee bar, and decor more closely resembling a downtown loft than a traditional bank president's office. Now, they did concede most of these expenses could be justified as a method of marketing, but the problem was it wasn't long before that he started commingling his funds. He had a bank-issued American Express card, and what he did to make the payments, the bank has a checking account just like everyone else. A small business has a checking account, so does the bank. Well, it created an overdraft of up to $200,000. And the regulators and the accountants get pretty particular on how you do this stuff, but it had to be covered. So what he did, he got a fellow board member, a friend of his, to increase that board member's loan from 1.2 million to 1.4 million. He approved the loan. The loan funds were wired to his friend. The friend in turn wired it back to Aaron in a different account, and then Aaron wrote a check to cover that overdraft. The significance of that overdraft is this is a bank that made, let me give you the exact number, made $439,000 in 2024. Not a lot of profit for a bank. And when you have a $200,000 overdraft, that wipes out half your profit. So he then covered that overdraft. And in the banking terms, that $200,000 was a true loss that should have been written off on the bank's books. But because you had that new infusion of capital to cover it, it's a wash. And that is, you're transferring that loss in the form of a new asset by increasing the borrower's loan from 1.2 million to 1.4 million. It's an accounting trick to balance the books, but it significantly understates the true profitability of the bank, because the assumption is if I'm taking that loss and putting on an asset, that asset's going to be worthless. So after he did that, they weren't too happy about him, but let me tell you some of the things he spent money on. This is for him personally, and I'll read off this list. He bought a timeshare for $18,349. He caused, I love this, $1,295 in personal expenses that the bank somehow reimbursed twice. So he charged it on his card and then he got paid again. He spent $48,604.60 in a home entertainment center, projectors, screens, and speakers. That's a nice setup, 46 or 48 grand. And of course, he withdrew $5,000 in cash. So that was all on his American Express card. And with the flashy lifestyle and the accounting, the regulators came in and started asking questions. And he said, where'd you get the money to pay off the bank overdraft? He said, oh, I sold some crypto. And I know regulators, and regulators are going to go, fine, let's see some documentation. Let's see, let's talk to you, start making some representations. And of course, that's when the house of cards fell down. Now, it's funny when you talk to this, I got to read what the defense says. I should jump ahead to say he got, give you the exact thing, he got 6 months in jail, followed by 1 year of home confinement, and he had to pay $100,000 in restitution. So he obviously ruined his what career he had in banking, caused significant damage to the reputation of the bank. And by the way, dad and son weren't alone in this. There were other figures that have been sanctioned by the FDIC. They were issued cease and desist orders and banned from the industry. So it was not siloed directly to Bob and son. I'm going to conclude with this. This is interesting. This is what the defense says in terms of mitigating his sentence. By the way, the defense did their job. The prosecutors wanted 15 to 21 months in jail. He only got 6 months. But he said, the defense said, you know what? This was awfully lot of authority and control over a complex business operation for a young man, 34, 35 years old. While Mr. Johnson has accepted responsibility for his criminal act, and he appreciates that great opportunities bring great responsibilities, a proper sentence in this case must consider that Johnson was in a position more typically filled by an executive with 20 and 30 years more experience than he had. So I guess when you get older, you realize you cannot use the bank credit card to buy a home entertainment system. Perfectly okay for a 34-year-old young man to do that, but you only make those decisions after you have another 20 or 30 years worth of experience. He was very young and inexperienced. He was overwhelmed with the scope of his responsibilities. He has acknowledged that he handled it badly, indeed criminally, but the punishment for this exercise of poor judgment is properly considered in light in his lack of training. So he got off a little bit. Obviously, his career is blown. The prosecution saying he has a number of different type of assets floating around. But one thing I want to say is where the regulators get bankers is in a common situation where you have a bad loan. In this case, you have an overdraft, and then the bank does something called a renewal or a new loan. Now, he knew he couldn't get a new loan for that 200 grand overdraft, but he could disguise it by getting his friend to increase the line of credit, which creates an asset for the bank, removes any doubt, and it's a performing asset, so there's no loan loss attached to it, removes that possibility of the revenues, of the profit being cut in half. Anyway, fascinating story, 6 months in jail, Aaron Johnson. Thank you for joining us for Fraud Friday.